Let's talk about one of the most overlooked tax moves in real estate investing, the home office deduction, and whether you, as a full-time rental property owner, can actually claim it. Most people assume this deduction is only for freelancers hunched over laptops in coffee shops. But what if your kitchen table is quietly running a mini real estate empire? Here's the thing. The IRS does not care how glamorous your office looks. They care about whether you are running a legitimate business from a dedicated space, if you are actively managing multiple rental properties, fielding tenant calls, reviewing leases, tracking expenses. You may already qualify and just not know it. The catalyst behind all this confusion is a blurry line the IRS draws between passive investors and active real estate professionals. Most rental income is classified as passive by default, which sounds harmless until you realize passive activities come with a completely different rulebook than active business income. Think of it like a nightclub with a velvet rope. Passive investors stand outside in the cold, while active real estate professionals walk right in and access deductions that others simply cannot touch. To cross that rope, you generally need to meet the real estate professional status test, which requires spending more than 750 hours per year in real property trades or businesses, and more than half of your total working hours in those activities. Now, here is where earlier optimism collides with cold reality. For a lot of investors, they buy 2 or 3 rentals, call themselves real estate professionals at a dinner party, and then discover at tax time that the IRS has a very different opinion. The psychological sting of that moment is real, and tax professionals like Brandon Hall of Hall CPA have noted publicly that this is one of the most commonly misapplied concepts they see among self-managing landlords. But do not let that discourage you, because the pattern here is actually well documented and learnable. Investors who cross that qualification threshold and maintain meticulous time logs consistently unlocked home office deductions worth thousands of dollars annually, effectively turning a spare bedroom into a legitimate write-off backed by the tax code. This fits neatly into a broader cycle where tax strategy lags behind investing activity. Most people invest first and optimize later, which is understandable but expensive. The real estate investing community has increasingly rallied around the idea that your back office is just as important as your deal flow, with educators like Brandon Turner and forums like Bigger Pockets hammering this message for years. A common misconception worth demolishing right now is that you need a separate entrance or a professional grade setup to claim a home office. The IRS simply requires that the space be used regularly and exclusively for business, exclusively being the key word. So no, the guest bed in the corner does not disqualify the room, as long as it stays a guest bed and not your office. The actionable lesson history keeps teaching is this: document everything before you need to, not after the audit letter arrives. Keep a time log, use a dedicated room, and make sure your business activity, emails, lease management, contractor coordination is traceable and consistent throughout the entire tax year. Moderate your risk here by not overclaiming. Deducting a 4-bedroom home as 100% office space when you have a family of 5 living in it is the kind of move that turns a smart tax strategy into an expensive IRS conversation. Claim only the percentage of square footage that is genuinely dedicated exclusively to your real estate business operations. The philosophical truth at the center of all this is that the tax code rewards those who are organized, intentional, and consistent, not those who are simply enthusiastic. Discipline in your record keeping will always outperform conviction in your hustle when it comes to surviving scrutiny. And if you are comfortable with any outcome here, it is because you prepared rationally, you either qualify and claim with confidence, or you do not qualify yet and you build toward it with a clear plan. Either position is a good one, as long as you are moving deliberately and not guessing. The irony is that the IRS built these rules to reward serious investors, and most serious investors do not even know the door is open. You have been running a business from your home office this whole time. The only question is whether you have been keeping score. Talk to a qualified CPA who specializes in real estate before filing. Because the difference between doing this right and doing this wrong is not a gray area. It is auditable, black and white. And if you are ready to take the next step, check out our links in the description below where we can help you get started in real estate investing, connect you with home contracting work, and find lenders who understand exactly what you are building.